We've made a significant number of changes to our asset allocation stance this month. It's been prompted by our fears that trade war risks are not fully priced in the market, and also by increasing risks in emerging markets. In particular, we've downgraded equities across the board, we've upgraded our fixed income stance in DM and downgraded in EM, and we have downgraded our China equity stance from positive to negative, which moves us to underweight emerging market equities in the model portfolio. In emerging markets, there's been one risk which has been continuous throughout most of this year, and that's quantitative tightening and the end of quantitative easing. And we've seen certain emerging markets such as Turkey and Brazil and even Argentina sell off as the cost of foreign liquidity rises. This risk is only going to increase as ECB QE fades and US QT increases. But in addition, there appears to be a slowing of Chinese activity, which is slowing trade growth, and heightened fears over the trade war. In developed markets, we think trade war fears are also underpriced at the moment, particularly in Germany and Australia, where we have downgraded both to a negative stance. Germany is exposed to the risk of car tariffs, and with the US government investigating auto imports through a Section 232 investigation, which we expect to report around about the time of the midterms, any increase in tariffs on EU car exports would hit the German market the most. Australia, meanwhile, is at the nexus of both trade war risks through its exports to China and economic slowdown in China through its close trade ties. We've downgraded the US from positive to neutral, but we remain slightly overweight in the model portfolio. And this is because the macro backdrop is still very positive in the US. Earnings season this month appears to be very strong. Employment growth remains strong. Wage earnings are continuing to grow. The Fed does appear to be behind the curve and inflation is rising, which should be positive for equity markets too. But with the risk of trade war, we think that there is a risk of a fall, so we have reduced our risk overall. And our increase in our stance on fixed income reflects the expectation that the large rises in yield are probably over for now. In the US, for example, positive carry earns about 34 basis points a year, which means that yields would have to rise by more than 34 basis points for a negative total return to justify a negative stance. And with record short positioning in treasuries, as well as increased risks over trade war, the chance that the Fed may only hike 2 more times before pausing, we think that the balance of risks is now to unchanged or lower yields.